What is up, everybody? Welcome back to the channel. Today I'm going to give you my take, my reaction to Dave Ramsey's latest advice on the housing market and where home prices are going to go from here. I'm going to share with you why I think he is way off and kind of contradicting himself. I'm going to share with you data from my perspective, as well as share with you my take and my forecast on the housing market going forward in order to help you make a more informed decision whether you're a buyer, a seller, or an investor in this market. But first, before I get started, you guys, I want to thank you so much for tuning in. My name's Jay Costa. I'm a local real estate investor as well as agent here in Northern New Jersey. If you get any value out of this video at all, please consider smashing that like button down below. It really helps me grow the channel. Also consider subscribing and clicking that little notification bell. That is all I ask. Now on to the video. All right, so first things first, I have nothing against Dave Ramsey at all. He's clearly a very successful financial guru. He's extremely well known. He's probably the biggest financial advice guy out there, and he predates social media. So he's built himself a huge business, and all kudos to him. But he tends to be more on the conservative side of things in regards to risk tolerance and investing and where to put your money and where to spend your money when compared to, someone like me. So we're going to go through this video from beginning to end, and afterwards I'm going to share with you my thoughts on what he says in the video, why I think he's kind of off, and I will share with you data to support my take on this video and on his advice. Let's get to it.
All right, let's talk real estate. A lot of folks are saying, I'm going to sit on the sidelines and wait on buying because house prices are going to go down. Let me help you with this. House prices are caused by one thing and one thing only: supply versus demand. How many houses are for sale versus how many buyers there are. Buyers are fewer in a bad economy, a high interest rate economy. There's fewer buyers, but they have to be less buyers than supply for house prices to go down. That's not going to happen. Here's the real numbers. Here's data, not feelings. Let's talk this through. 5 million more 35-year-olds right now in the millennial generation, prime house buying age, than there were in 2007. 128 million households right now. In 2007, only 116 million households. 12 million more households operating that need a house. And yet there's a shortage of housing. In 2007, we had 2.1 million new housing starts. This year, we'll have 1.4 million new housing starts. We have 50% as many houses for sale right now as we had in 2007. Inventory is at half. So the number of buyers would have to go down so dramatically before the house market prices go down. It's not going to happen, guys. House prices went up 32% in 2020, 18% in 2021, 7% this year in 2022. Next year, projected to be a 5% increase. Every year for the next 5 years, we're going to have fewer houses for sale than buyers wanting to buy them, driving the price up. House prices are going to go up every year for the next 5 years. If you're ready to buy, you're in good shape financially, you need to buy now. Don't wait on house prices to go down. They're not going down. What goes up must go down. No, it doesn't. I just gave you data, real facts. They're not coming down.
So I'm going to start with what I agree with in Dave Ramsey's advice here. So first, yes, the housing market, just like any other market, is heavily dependent on supply and demand. But what he's discounting is the effect that higher interest rates have on the demand side of the supply and demand situation. For instance, a home buyer that was qualified for up to a $500,000 house in 2021 is now only qualified for a house that's probably under $400,000, let's say $380,000 or so. That is a huge drop in purchasing power. And if the buyers don't have the same purchasing power that they did the last couple of years, that will most likely bring home prices at least down to level and stagnant, and maybe even to have a bit of a correction going forward. The other part that I do agree with Dave on this is he does cite a lot of demographic shifts in the country, population shifts in the country that support the housing market going forward. He cites the millennial generation first and foremost being of prime home buying age, and that is true. There are demographic situations in the country that support the housing market to continue to rise in the next, let's say, decade. But he's only focusing on the number of people who want to buy a house, not the number of people who are able to buy a house. And that number has dropped in the last year since interest rates have gone up so quickly. So while I agree with Dave that there is still a huge amount of people with the 6% interest rates that we're at and inflation eating away at their stagnant wages, most home buyers or most potential home buyers just simply can't afford homes at these prices anymore. This comes after 2 straight years of absurd home price appreciation where home prices skyrocketed because of not only supply and demand like Dave mentioned, but also all-time low interest rates. With mortgage rates at all-time lows in order for the Federal Reserve to stimulate the economy during COVID lockdowns, home buyers were able to qualify and even afford a monthly payment on a loan that was way higher than they normally could in a normal housing market. That made home prices soar across the country. Now, the issue is, now that we don't have those all-time low interest rates anymore for home buyers to benefit from, how can today's home buyer effectively afford home prices at these astronomical levels? The simple answer is they can't. And you're seeing that already in the market, in certain pockets of the market anyway, where demand is almost completely dried up in places that appreciated the most the last couple of years. He is correct about the shortage of housing in this country, but we were also short of housing in 2017 and 2018, and you didn't see these astronomical home prices that we see now after 2 years of being artificially inflated by the Federal Reserve. And he states that buyer demand would have to go down so dramatically in order to cause home prices to go down. But I believe he is really discounting the effect that a 6% interest rate could have and already is having on the demand in the housing market as we go forward. And you add in the fact that the living expenses because of inflation are so overpriced. I mean, people are paying $5 a gallon for gasoline, way more than they used to for everything. All living expenses are up significantly, and that pinches people's pocketbooks and stagnant wages even further, making the cost of living and purchasing a home completely unattainable for the very demographic that Dave is citing. That's for his reason as to why the home prices are going to continue to rise. Now, Dave Ramsey put up a second video telling you what he thinks a qualified home buyer is, what it takes for you to be sure that you can afford the home that you're paying. Let's look at this video right now from beginning to end, and I'll share with you my thoughts on that after, because I feel like it completely contradicts what he's saying and what he's citing in his first video about the housing market in general.
House prices are going to go up every year for the next 5 years. How do you know if you're ready to buy a house? Because if you're ready to buy a house, you need to buy now. All right, here's how you know if you're ready. You're out of debt. You have an emergency fund of 3 to 6 months of expenses, and you have a good, strong down payment. 20% is preferable because you avoid PMI. If you're a first-time home buyer, sometimes you only put down 5% or 10%. That's okay, but you're going to pay that stinking PMI. Get ready. Then when you buy on a 15-year fixed where the payment is no more than a fourth of your take-home pay. Well, I can't afford the house I like that's got the granite countertops. Then you can't afford that house. Hello. You need to buy a house you can afford. That's a good, wise financial decision, and you need to buy now. House prices are not going down.
Okay, so according to Dave Ramsey, a qualified home buyer has to meet a few different criteria in his eyes. Let's go through them one by one. And let's use the millennial generation that he's citing in his first video for his reasoning as to why the home prices are going to continue to rise for the next 5 years. So let's talk about the millennial generation, which I am a part of, so I feel like I could speak pretty clearly on this topic. His first criteria for whether or not you can afford a house is, number one, you have to be completely out of debt. So I looked into this a little bit. The millennial generation has an average household debt of $78,000. Number two, he says that you need at least a 3 to 6 month emergency fund. Well, millennials, 70% of them are living paycheck to paycheck. That means 70% of them have absolutely zero emergency fund, never mind 3 to 6 months worth. And number three, he says that you need a good, strong down payment, says that he'd prefer a 20% down payment to avoid the private mortgage insurance. But if you're a first-time home buyer, maybe 5-10% is okay. Well, good, strong down payment. There is good news and bad news. 25%, 1 in every 4 millennials, does have over $100,000 sitting in a savings account. So that is a good thing, although you would assume that they also have that household debt that we were talking about, most likely student loan debt and credit card debt. But the bad news is for Dave is that 41% of millennials have less than $15,000 in savings. And once again, you would assume that the people with less than $15,000 in savings also have huge student loan debt and credit card debt to deal with. So these numbers completely contradict what he's saying about the millennial generation being ready to keep buying these houses at an astronomical rate at these astronomical prices. Because going by what he says, almost no millennial would be able to even afford a house at these prices. So just going by these criteria that he's putting out for a home buyer, home prices will have to go down because nobody will be able to afford a home at these levels of pricing. Now, I'd actually like to get into the numbers a bit here because he mentions not a 30-year mortgage, but a 15-year mortgage, as well as making sure that your mortgage payment is only 1/4 of your income per month or per year. So let's run the numbers a little bit. So let's base this off of a $500,000 house. So you take the mortgage payment on a $500,000 house at 6% interest. You add in property taxes, which I'm in New Jersey. Property taxes are high here. Let's say for a $500,000 house, it'd probably be about $10,000. So you add that into your monthly mortgage payment, as well as your insurance payment. So let's do the math on a $500,000 house. A $500,000 house here in New Jersey, the property taxes are pretty high. They'd probably be about $10,000. So you add the property taxes of $10,000 per year in, as well as, let's say, about $1,500 in order to get homeowners insurance. Now, that monthly mortgage payment is not at 2.5% or 3% anymore. It is now at 6%. That mortgage on a 6% interest rate would turn out to be $4,300 per month. Now, going by his criteria on you shouldn't pay any more than 1/4 of your income towards your mortgage payment, that means that you would have to make $17,200 per month, which would be about $200,000 per year. $200,000 is way higher than the median or average household income, even in a high cost of living area like here in New Jersey. And remember, this is only for a $500,000 house. So basically he's saying you have to make $200,000 a year just to afford a $500,000 house. Those numbers don't add up. And the way that society is now, how many people and households that make $200,000 a year will be happy buying a $500,000 house? I'm going to say almost all of them would be much happier renting, which is why I feel that landlords are going to be the only ones in this housing market going forward that are going to be pretty insulated from any sort of potential downturn, because the less people that are able to afford to buy a home, the more people that are forced to rent a home. So landlords will benefit, and even if there is a slight correction in the rental market, it will be short-lived for these reasons. So as you can see, Dave's entire basis on why the housing market will continue to go up based on demographics and supply and demand, and the demographics of millennials in particular, completely contradicts his definition of a qualified buyer. So what's my take on the housing market going forward? Well, as I stated, I think that landlords will be pretty insulated from any sort of potential downturn or correction in this housing market. And I do think that there's going to be a correction in this housing market. You're already starting to see it in the data, but you have to remember that the housing market data is pretty lagging. The stuff that's selling now went under contract almost 2 months ago. So it's a lagging indicator. Almost all of it is a lagging indicator. So you need to keep that in mind. I think that if the interest rates stay where they are somehow at around, let's say, high 5s to low 6% interest rate on a 30-year mortgage, we may just flatten out home price wise. We may not see a downturn or correction in home values. But if the interest rates continue to go up, and if we're looking at 8% interest rate on a 30-year mortgage like a year or so from now, the home prices will simply have to come down. And I don't care how much Dave Ramsey or real estate agents cite supply and demand, the demand will be zero. So the only way to sell a home will have to be at lower prices. Now, Dave Ramsey is correct in his citing of demographic shifts and millennials being the perfect age to buy a home. And that's what I think will keep us from falling off of a cliff, per se, where I don't think that we're going to have a huge major crash in housing, because the demand at slightly lower prices, even with higher interest rates, will keep the housing market afloat, in my opinion. But at the end of the day, no one really knows what's going to happen 6 months from now, never mind 5 or 6 years from now. And for Dave Ramsey to call for the next 5 years of home prices to go up in value, he has no idea what's going to happen. I have no idea what's going to happen. And any sort of proclamation of something being guaranteed, just dismiss it completely. But don't listen to everything Dave Ramsey has to say, especially on the housing market. Let me know what you think in the comment section down below, what you think about what Dave Ramsey is saying in this video, as well as what you think and where you think home prices are going from here. Are they going to continue to go up because there's so many millennials out there ready to buy a house, like Dave Ramsey says? Are we going to stay pretty flat going forward because everyone's just kind of sitting on the sidelines seeing what's going to happen? Or are we due for a major collapse or correction in home prices in the near future? Let me know in the comment section down below, and I appreciate you watching. See you next time.